Welcome to Hi there, welcome to the Option Pit Method, Options for Stock Traders. What are you going to learn today? Lots of stuff. Let me start out by kind of standard language. This is for educational purposes only. None of this should be considered investment advice. Options have risk. Consult your financial professional. So, you can understand that this is neither investment, legal, or tax advice being discussed. For those of you who don't know me, my name is Mark Sebastian. I am the founder of OptionPit.com. We are an education and consulting business. On the consulting side, we work with hedge funds, money managers, asset managers, professional traders, helping them design, implement, and stress test option strategies. For the retail public, we try and teach retail traders to approach trading the same way we did as professionals. Our goal is for our traders to have a strong understanding of options before they start trading. It's a professional approach for the retail trader. So this is me here. This is Liz Klayman on the right, for those of you wondering, although I did like her dress as well. So, problem, trading stocks, I mean, a lot of people like trading stocks. They like to day trade or whatever. It's margin intensive. Investing in stocks ties up lots of capital. The market can lead stocks one way or the other, and it can be hard to tell which way the stock market is going throughout the day. These are all kinds of problems that we have when we trade. So what am I going to teach you? I'm going to teach you how options and stock are related. I'm going to teach you how to replace stock in day trading, and I'm going to teach you how to replace stock investing strategies, and I'm going to use some indicators to analyze VIX and pick out some directional trades. Stock and options. Options are derivative of stocks and futures, and really any option is derivative of its underlying. That means that for an option price to move, generally speaking, the underlying price must move as well, generally. All right. Obviously, with options as an insurance contract, there are exceptions that can cause it to move one way or the other, namely volatility, which we're going to get to. But for the most part, if an option is moving, there's usually some price movement involved. All right. And then how well that option moves with the underlying is called correlation. Things correlate. So for instance, if I tell my wife that her dress is ugly, there's a high correlation to that comment to me getting kicked in the shin by her. That's a high correlation. Options can correlate at any number between -1 and 1 to the underlying, depending on what the trade is. Delta. For option traders, how well the option correlates to its underlying is called delta. Thus, options have a delta between -1 and 1. Options that have a positive delta will move with the underlying. Options that have a negative delta will move opposite of its underlying price. Here's an example. All right, this is TLT. And what I want you to notice is, take a look here. They've got this delta, the 123 calls. This is an old picture, but gets the job done. Delta, the 123 calls, at this point was 80. The delta, the 129 calls, was 21. And generally speaking, the underlying was trading right around 126. So $3 out of the money, you get a 20 delta, or a 20% correlation. And $3 in the money, you get about an 81% correlation, which means if the underlying rallies $1, the 123 calls would be worth 81 cents more. So the TLTs, 123 calls have a delta of 80. If TLT moves up by $1, the 123 calls make $80 per contract, 80 cents in the options price. If it falls $1, the 123 calls will lose $80, 80 cents in the options price. All calls have a positive correlation. So if you sell a call, you're selling positive correlation, which means you're creating negative correlation. If you buy a call, you are creating positive correlation because you're buying exposure. All right. So here is put delta. And what I want you to notice is take a look at these TLT 127 puts. They have a 61 delta. So the 127 puts have a delta of negative 61. Right? It says positive 61, but all puts have negative deltas. So the sign is implied. So for every dollar TLT rallies, the 127 puts will lose $61, 61 cents in the options price. For every dollar TLT falls, the 127 puts will make $61, 61 cents in the options price. All puts have that negative correlation. That's an important thing to remember. Now, replacing a stock. The minimum overnight Reg T margin, so that if you get margin and you're not on portfolio margining, right, the best margin you can get Reg T is about 2 to 1. Some brokers do have better intraday margin. This means that if I buy 1,000 shares of a $100 stock, my margin is going to be 1,000 times 100 times 0.5. So my margin is $50,000. That capital is tied up. All right. The worst thing as a trader is to have capital tied up. The less the better. All right. In buying a heavy delta option, I can replicate the exposure of 1,000 shares of TLT stock using far less capital. For instance, if I buy 13 of the TLT 123 calls, I can get about 1,000 deltas. I can get what amounts to a correlation to TLT of being long 1,000 shares. But compare the cost. All right, these calls cost me $3.30. So my stock margin is going to be 125.77 times 1,000 times 0.5, or just under $63,000. My option margin, on the other hand, is going to be 330 times 100 times 13. So that margin is just a hair under $4,300. So if I think TLT is going to go up $2 on a day or a swing trade, I know it's a big move, but TLT's had some moves like that lately. My goal is to make $2 on a day or a swing trade. All right, I'm trying to make $2,000. My return, if I go long the stock, is 2,000 times 6,000, over 62,885. If I use options, it's 2,000 over 4,290. So look at the margin differential. Look how much more efficient my capital is. I'm trying to make the same amount of dollars, but I'm using what, 7% of the capital? That's really advantageous. That's really great. All right. So now, if I'm choosing stock simulation, if I really want to simulate a stock, I typically go for a 75 or an 80 delta option correlation. It's typically going to track the stock well enough that one can use it in day trading or swing trading. It also, and this is the key, this is why I don't use like 100 options that have like a 1-to-1 correlation. The liquidity dries up when they start to correlate at 100. So it stops being easy to get a fill. So I want that in the money option, and I should be able to reasonably get in and out in short order. Should not be a problem. So if one is going long, you can buy puts. If one is going short, or if one is going long, you can buy calls. And if you're going short, you can buy puts. Or you can look at the volatility and start selling options as well. All right, and I do see some questions. We'll get to them at the end. All right, so I've got some YouTube videos. If you go on YouTube, and there's a whole host of stuff that we have on YouTube. If you search Option Pit, and you can search all these like really active ones. So, you know, this is the one with about 8,000 views. That's one people really like. And then I've got, I got a bunch of videos on here on YouTube. All right. So absolutely worth a look-see at some of these videos. So take a look at using Option Pit or using volatility to trade for direction, and it'll add that wrinkle. So in short, though, if volatility is normal or low, I can buy calls or puts. If volatility is really high, I can sell a deep put spread or a call spread. And I can sell an 80 delta put or an 80 delta call and buy a 5 delta call or put as a hedge to reduce margin. And then I'm recreating that volatility via, I'm recreating that stock exposure, but I'm getting short options to the long. So if volatility comes in when it's really high, I can do a lot better selling options. Right? So in the past, I've showed how short puts and covered calls can enhance the income of stock investors. The issue is that the margin associated with owning the stock or shorting a put is that same Reg T margin. All right. I'm a big proponent of covered calls. I'm a big proponent of cash secured puts. All right. That's another. We have a great one on YouTube called Riding the Option Wheel. Totally worth checking out. All right. And that's all about selling puts and buying stock and selling covered calls. But there's a better way to trade it. And once I show you this, you're never going to want to own stock again. So rather than executing a covered call, one can execute what's called a diagonal spread. All right. So what I do is I buy a heavy long-term option, all right, with a heavy delta in the 50 to 70 delta range. So an in-the-money option, maybe not as deeply in the money, not 80, all right, but a heavy option. Then I sell an out-of-the-money option closer dated that is a 20 or 30 delta call. I can use monthly options or weeklies. So here's an example of something that I've done. This is from last year. This was a trade we did in our strategy letter. We bought the Apple 110 calls in January for $4.50. We then sold the December 1, and the stock was, I think, 112, not where it is now. And we sold a December 114 call 75. It expired worthless. We sold a December 26 114 call 55. It expired worthless. Then finally, we sold a December 115 call. So notice that the call changed because the stock had rallied a little bit, and we collected 70 cents there. At the end of the cycle, my Jan 110 call was worth $3.65, and my Jan 115 call was worth about $9. So I lost 95 cents on my January 110 calls, but look how much income I produced. All right? And I didn't have to spend a lot of money to own Apple. All right? I mean, I can look at one of those right now. Here, give me a second. Open this up for you. Come on. All right, well, while we're waiting for that to load, here's another example. This is one I did on my show called Track the Trade. All right. That I used to host on CBOE TV. I bought a Facebook January 75 call. And I sold a November 28th 75 call at 22 cents. I covered it for $2.46. I sold a December 77 call at 132. It expired worthless. I sold another 77 call at 80. I covered it for 86. I sold a 77.5 call at 130. I covered for $2.45. I sold an 80 call at 80. I covered it for 78. And I sold an 81 call at 42. I covered it for 12. So the point of this was to show you that, yeah, there were some trades here where I actually lost money. I mean, take a look here. I lost like $2, made $1.30 back. I lost 6 cents. I lost $1.20 or $1.10. So we'll say I'm out $2.25, and then I made 2 cents here, and I made 30 here. So I lost about $2. But my 75 calls are worth $4.70. So I made money on those. So that's kind of an example I wanted to show of, you know, even when it doesn't go perfect, it's still not bad. You know, that's one of the nice things that I really like. All right. So, you know, let's look how we might set one of these up in the, you know, what's a name that the group likes. I'm going to say Goldman's had a big day. I don't really want to do Goldman. I'm going to do Facebook. No, let's not do Facebook. That's boring. Ulta Cosmetics or USO. We'll say we want to go long oil. There we go. I'm not a big proponent of going long oil. So how might I set up a trade? All right. Well, I might go to March, and I might buy with the stock 1093. I could buy a 10 call for 145. I could buy 10 of them. And see, I get that delta. I get 700 deltas of exposure. So it's about a 70 delta call. Well, then against it, I go out to the December 9 contract. Stock 1093. I can sell an 11.5 call at 15. So maybe I sell that. There's my trade. And you know, what I want you to notice is what my risk chart looks like. All right. Looks a lot like a stock, but I've lowered my cost basis, and my margin is almost nothing. Pretty simple. So when do I execute these trades? All right, it is a great strategy in just about any environment. While IV may be high in a back month, it will typically be higher in the front. So vol distortions will quickly be covered. All right. It's not great when volatility is through the roof, but it's pretty great. And you want to be watchful of a major vol distortion a month. So don't like sell an earnings month. Don't do that type of stuff. All right. All right. It can be great to buy an earnings month or week and then sell stuff in front of it. So I like using earnings as kind of an anchor because those volatility premiums are going to be higher. And what it lets me do is I sell the front month or weekly option in front to basically finance it. All right. So it should be executed when one expects the stock to move slower. So in Apple, I was really right, and in Facebook, I was really wrong. And even though I was really wrong in Facebook, Facebook moved quickly, I still managed to make money. And that's the thing to remember. Even though I was wrong, I managed to make money. All right, now let's talk about VIX as a trading indicator. The S&P 500 future is really the leader of the market. All right, it leads SPY most of the time. It leads the broad market indexes and will point more or less to the direction many stocks will take in the near term. So when I'm trading stocks, all right, when ES is weakened, so will most stocks. Even if the stock is moving in the opposite direction, it will soften with ES. So when I'm trading, I'm looking to buy. I'm watching S&P futures. If I see S&P futures getting soft, I will wait for the stock to come to me. If I see that S&P futures are really bid and there's a strong buy, I will chase the stock. I use S&P as kind of my, should I chase or should I let it come to me? All right, now, in volatility terms, though, in the scenario in which came first, the chicken or the egg, volatility, or implied volatility, is the chicken. The majority of the time, VIX futures, VXX, and VIX itself will tick in front of the S&P. Believe it or not, if you are a VIX and S&P 500 trader and you're not watching VIX futures, you are missing out. VIX futures almost always lead SPY and ES. So even if you want to keep trading stock or trade futures and you don't want to trade options, you should have picked up right now that you need to start watching VIX, which is the volatility indicator. It's an option. It's an indicator based on options. It's options for stock traders. So this is just a tick chart from October. And what I want you to notice is when you see kind of flatlining volatility, all right, and you see kind of this market chop, that can be a sign that we're getting set up for things to go lower. So we've got a choppy market that's maybe even climbing higher, and volatility is not dropping. What does that tell you? Well, we're probably about to get a little sell-off, and we did. You get your sell-off, you get your vol rally, then it starts to drop. And what do you notice that drop? S&P is to the moon. But as soon as they picked up, check this out. Volatility picks up here pretty significantly. Stops moving with the little rally here. Basically said, hey, look out. Boom. Straight down. Anytime you see the S&P running higher and volatility isn't dropping, the market's going to drop. All right? Almost always. So now let's talk about some swing trading patterns. So one of the things I use, and this is even better than intraday, is correlation breaks. So over multiple days, if the S&P is rallying and VIX is flat, slightly down or slightly up, that's super bearish. Let's take a look at this. You've got S&P rallying, volatility dropping. That's a good thing. What about here? You've got S&P rallying, and what's volatility doing? It's not moving. What happened? SPY sell-off. Here's another one. one of the strongest multi-day signals that the VIX can send is a correlation break on a down move. So over multiple days, if the SPX is down and VIX is flat, slightly down, or slightly up, that is even more bullish than correlation break number 1 is bearish. And I saw it over 2011. This is a great one for 2011. Look at this. Vol selling off, nothing, and you can see the underlying is dropping. Volatility is not really moving. What happens? We rally. Underlying is dropping. Volatility is not moving. We rally. And we've seen that over and over and over. And one of the best examples is Brexit. Let me show you this. Carnation instant Brexit. I want you to look. This red line represents volatility. And this is 6 months. So I want you to look at this. We're going to hone in on June. Take a look here. So you get, here we are, day before Brexit, market tanks, vol, just absolutely collapses. Now here's another day. The market is down big. What else is down? Volatility. Clear sign that something was going on. And then what happens? We're off to the races. Volatility collapses. The underlying rallies all freaking month. Pretty crazy. All right, so now I want to show you a couple scans that we do. And you can get these in LiveVolX, which is the platform I'm using. So we're one of the cool things. So LiveVol is owned by the CBOE. And if you look at their scanner, we are the only group that actually has our own personalized scan. And the one we like is, here's one we like. And what it looks for is stocks that are right near their 52-week high and and where volatility is right near its 52-week low. It wants you to buy an out-of-the-money call. And you can see our scanner is going crazy telling us to buy calls in a lot of these names, which are interesting. There's a few in here that I wouldn't, NVIDIA is interesting. There's a lot of names in here that, on top of some of these indexes, you've got Buffalo Wild Wings. Our scanner wants us to buy calls. So, the way this scanner would work is you'd go in and you'd look and say, hey, what's hitting? And we'd say, okay, Buffalo Wild Wings. And then after I do this scan, I would go to basically January. All right. Then the stock's 168.70. It would want me to buy a 170 or a 175 call. That's what it would want me to buy. All right. That's scan number 1. All right. So buy a call that's, kind of right out of the money or up to 2% out of the money. Wait a week, and that call will probably be winning nicely. So here's some ones we've done in like Ulta Cosmetics. I just cleaned up in Ulta over and over and over again. When it's hitting highs and volatility is at a low, it's a chance to buy. All right, and if I pull up a more recent chart of Ulta, we've seen that on multiple occasions. Ulta was hitting these new highs. Now, one thing that was interesting is, look what happened here. Ulta takes off. And yeah, they had earnings coming up. But, this thing is off to the races. It's dropping right here. 52-week low. All right, July 2nd or July 20th, 2016, 52-week high, vol 52-week low, stock is off to the races. All right, I mean, if you bought on the 20th, if you bought that call on the 20th, the stock closed 255. A week later, you know, and it's up $5. You know, on the 1st. And on the 28th, it's up $6. Gets up as high as you know. If you waited longer, you can keep going. It's a really great strategy, just for simple finding things to own. Now here's the other one. I actually like this one better. Find a stock at a 52-week low. Check the 52-week high IV. If the stock is not near a 52-week high and near its lows, it's going to go lower. So when you see a stock dying and volatility isn't increasing with it, that stock is going to keep going lower. Right? So these are some ones that we saw. Macy's had this problem. All right, hit a 52-week low at the time and just kept going. Volatility didn't do anything with it. Look at this. It's got sinking volatility and the stock is sinking. That is bad news. Macy's tanked. So if I look on my scanner now, you know, we'll go pull up another option to scan. I've got that same one, the you know, what put should I buy? So right now it wants me to go short TripAdvisor. Cody. Although Cody's a deal stock, so that makes it a little more interesting. But it wants me to short TripAdvisor. And so with the stock 48.20, if I look for a chart, I mean, look at that. Stock is dying, and the volatility is about as low as it's going to get. So what I might do is go out to January again, and maybe I buy the 45 calls or 45 puts for 90 cents. Maybe I'd do something like that. If I wanted to get clever, I could even do a diagonal or like a calendar. And I could sell like a 40, I don't know, I could go to like December 30th in front of it, and I could sell like a 40, you know, some sort of put underneath. All right, so they're begging that one. So in summary, use in-the-money options to simulate stock, use calendars, diagonals to simulate cover call, use vol as an indicator. So now let's talk about what's going on the 10th. So that's Saturday the 10th. So a week from Saturday, I'm doing trading stocks and options with the Fed. Interest rates are really starting to move, and if you think that type of movement isn't going to have a profound effect on the stock market, you got another thing coming. Who remembers the last time we were in a bull market for interest rates or a bear market for bonds? I was in high school, and I'm 38 years old, folks. So it's been, and you know, the banks, as we know them today, did not exist in a rising interest rate environment, really. And so it is a just incredible time to be thinking about trading options and stocks. So we charge $297 for this class. If you go to our store, you know, this is a new class, but if you go to the Option Pit store, you go to optionpit.com, you go to our store. I mean, all of these classes are, you know, $247, $395, $250. You know, our cheapest one is $147. All right, and so, that's recorded. This is live. You get to keep the recording, you keep the slides, and we're charging $147 instead of $297. This is going to be a $300 course on November 12th when we put it in the store. Or not November, on December 12th when we put it in the store, right? And so today it's just $147, and it's going to be $147. Oops, let me do that. And it's going to be $147 through Sunday, and then I'm raising the price to $197. So you got till Sunday to pay $147, and then we're going to jack the price to $197. All right, so this is going to be, and if you're looking for the replay, we will have that sent out tonight. And yeah, the slides will be available. If you want, email me for the slides. This webinar is recorded. You'll be able to see it on YouTube. It will be on the blog. All right. And what other questions do we have? If your stock goes down 5%, you can lose 50% on the option. Yeah, but that's, but you actually lose fewer dollars than you lose if you buy the stock. What is your criteria for a long position? I definitely am a momentum trader, but it's also I typically look for stuff that is turning around. So I like to I like to find stuff. I don't really look at EMAs or any specific indicators. I look for things where they're getting torched and I play them to turn around the next day when I go long. So for instance, I made a killing this last month going long the NASDAQ on every day it got tanked. All right. Any other questions? So you go to optionpit.com/. Do you make more firm trading or from selling info? I run a hedge fund. Isn't selling way in the money call dangerous? Not if you hedge it. So I don't subscribe to I don't subscribe to the whole doing stuff naked. What is it's ES? It's ESU. No, it's ESZ6 right now. And here's where you can sign up for the course. And if you sell an in-the-money call, it's only dangerous if you don't hedge it with an out-of-the-money call, which we ESZ6, not V. Z is in Zulu. All right, and you can email me mark@optionpit.com or info@optionpit.com if you want the slides. Any other questions? We discussed these strategies, yeah, in the DEES webinar. Yeah, we're going to be digging in. I mean, it's going to be a 3+ 4-hour-ish class. 2 sections. We're going to dig into row and interest rates and all the things that affect options, and then I'm going to dig extensively into bond options, TLT, trading leaps, different things like that. There's going to be some really cool things that we discuss. You can see my email, the email right on the page right there. Email info@optionpit.com right there. Yeah, we're going to be digging into lots of stuff. This is our coursework is always intense. That is the one thing I can promise you. You're never going to be like, wow, that wasn't enough information, Mark. And the date is going to be December 10th, so a week from Saturday, and it's going to be from 9:30 Eastern until about 1:30 Eastern. We will record it. You will get a recording. You will get the slides if you can't make the whole thing. What volatility range do you like for diagonals? It depends on the stock. So every stock has its own volatility range, but generally with diagonals, I'm looking for lower volatility rather than high. And yes, I do switch strategies when volatility is expensive. For stock replacement, can you buy a call and sell put, otherwise known as a risk reversal? Yeah, but that's going to tie up the same amount of margin as Reg T. So you can, but you're going to have more margin. I meant IV percentile. You know, I don't look at IV percentile very much. I mean, I generally can tell when things are cheap or when things are expensive, but I've been looking at options for 20 years, so it's, that's not something I spend a lot of time at looking. And typically when IV percentile is really low, that's because the stock isn't moving very much. When it's high, because it is. So really, I'm generally more comparing how much is this moving relative to where the volatility is priced, rather than looking at volatility in a vacuum. All right. Any other questions? All right. Make sure you check out my my class and you buy it, and you're gonna love it. It's a brand new class. We've never done this one before, so we figured with it'll be, the Fed decision is going to be 3 days after, so it'll be extremely timely as well, which will be fun. All right, guys. Thank you, doctor. Doctor. I am not a doctor, nor do I play one on TV. All right, guys. I want to say thank you for your time and for coming, and I will talk to you soon. Have a good one.